Hey, what's up, my friend? So, in today's episode, right, I want to share with you four things to avoid when you put on a trade. Okay, so first thing first is number one, you want to be aware, right, of buying into resistance or selling or shorting into support. And often, right, when traders they click buy, they are not aware that they're actually buying into an obstacle. They're buying into an area of resistance, right? If you zoom out your charts a little bit, sometimes you might realize, oh man, I'm actually buying into a area of resistance. This is where sellers could potentially come in. So be aware of this, right? When you click the buy button, right, be aware that you're not buying into a resistance area. And usually, if you are too zoomed in your charts, right, you might not see this. So just zoom out your charts a little bit, right? Look at the big picture and see where you're actually buying into, right? And avoid buying into an area of resistance and avoid shorting into an area of support. Number two, you don't want to be buying, right, when the price is overextended, right? So how do you tell whether the market is overextended, right? So the market is overextended when, let's say, for example, you overlay the 50 period moving average on a price chart, and you notice the price has bounced off the 50 MA number of times. And right now, the price, imagine that it's very far away from the 50 period moving average. It's overstretched away from the 50 period moving average. And you don't want to be buying at this point in time because if the price reverse, if it pulls back towards the 50 MA again, there's a good chance that you'll get stopped out, right? If you're buying when the price is high and if it pulls back towards the 50 MA again, you will likely get stopped out. So be aware of this, right? Don't buy when the market is overstretched. And you don't have to use just the 50 MA to define whether the market is overstretched or not. You can use a tool like drawing trend channels, right? You can draw the upper boundary, the lower boundary. If the price, again, right, if it's near the upper boundary, you don't want to be buying, right? Look to buy when the price is near the lower area of the trend channel. That will make more sense. Number three, avoid chasing the markets, right? This is especially when I know the candles are bullish, right? It's so huge, right? Things are exciting. Let me buy. And the problem with chasing markets is that this is where the market is prone to reversal. This is where the market is prone to a pullback. And when you chase the market, right, usually there's no like floor or support, right, that you can lean against to set your stop loss. And this is why it's very common for the market to explode up higher, only to reverse back and give back all their gains pretty quickly because there's no floor, there is no swing low, there's no area of support to hold up these higher prices. If there's no structure in the markets to hold up these higher prices, the price could just reverse back in the opposite direction. And guess what? When you chase breakouts, okay, and that happens, you can stop up pretty quickly as well. Okay, so avoid chasing the markets. And one last thing, the fourth thing is avoid trading against the trend. You want to be aware of whether you're trading with the trend or against the trend. All right, you can take counter trend trades, but I would say it's far easier to make money when you're trading with the trend. Right, when you're trading with the trend, your profit potential is greater. Why do I say that? Because if you look at, for example, an uptrend, there is two legs in an uptrend. The trending move where the price moves in the direction of the trend, and the retracement move or the pullback move, however you want to call it. This is where it is the retracement of the against the trend. If you look at the distance of both legs, the trending move is where the market moves much more compared to the retracement move where the profit potential is lesser. So if you're trading with the trend, your profit potential is greater. If you trade against the trend, your profit potential is clearly lower. So if you want to find an easier way to make money, trading with the trend, right, would be my suggestion. Okay, so these are the four things that you want to pay attention to and also to avoid, right, whenever you put on a trade. And one last bonus tip for you: whenever you trade, okay, you want to be aware of what the higher time frame is doing as well. Let's say you are entering on the daily time frame, right? Don't just look at your daily time frame and then just make your decisions from there, right? Look at what the weekly time frame is doing, right, and to make sure that you're aligned, right? Your trading direction is aligned with the higher time frame as well. So, for example, if you are buying, let's say, breakout on the daily time frame, look at the weekly time frame and make sure that the market is at least in a range or in an uptrend. You don't want to be buying breakout on a daily time frame when a weekly time frame is in a downtrend, right? That's a low probability breakout trade, right? So be aware of what the higher time frame is doing. When the both time frames, their trend direction are aligned, right? That's where you find a higher probability trading setup. All right. So with that said, I have come towards the end of today's episode, and I wish you good luck and good trading. I will talk to you soon.